All right, today we're going on a hunt. It's the quest that every single investor is on, the search for those hidden gems, those stocks that the market has totally missed. It's basically a modern-day treasure hunt. So let's get into it. You know, the dream is simple, right? We all want investing to be this easy, straight line to success. But let's be real, the path to finding real value is, well, it's a lot more complicated than that. It takes a good map, the right set of tools, and honestly, a pretty steady nerve. And that's the big question, isn't it? If you strip away all the noise, all the hype, how do the professionals, the people who do this for a living, actually find true, lasting value in the market? That's what we're here to figure out. Okay, so our story has to start with the original treasure map, the big idea that pretty much changed finance forever, modern portfolio theory. Think of this as the academic foundation that almost everything else in modern investing was built on. So what is MPT? Well, the core idea is pretty brilliant. It's not about finding one superstar stock. No, its big insight is that you should judge an asset based on how it fits in with your entire portfolio. It's all about the team, not just the individual player. And it all kicked off back in 1952. An economist named Harry Markowitz published this groundbreaking paper. And what he did was prove, with math, that diversification, not putting all your eggs in one basket, wasn't just some old saying. It was a seriously powerful, Nobel Prize-winning way to lower your risk. And all of this work gave us something called the efficient frontier. The easiest way to think about it is as this perfect curve. They sometimes call it the Markowitz bullet that shows you the absolute best return you can possibly get for a certain amount of risk. In a perfect world, this is where every single investor would want to be. But here's the twist. What happens when that old map is wrong? This is where we hit a major turning point. We're leaving the neat and tidy world of theory and jumping headfirst into the messy, chaotic reality of the actual market. And suddenly, that old map starts to look a little shaky. And you can see the problem right here. MPT is built on these really clean assumptions that we're all perfectly logical robots making rational decisions, that market returns follow a nice, predictable bell curve, and that our goals are set in stone. But the reality check? Come on, we make emotional decisions. The market is wild and has these extreme swings, what quants call fat tails. And our financial goals? They're changing all the time. And this is the real danger. As the folks at ABC Quant put it, if you just take a traditional model like MPT and try to apply it blindly to the real world, you are going to get some unexpected and most questionable results. The map just wasn't drawn for that kind of territory. Yeah, critics have called these models beautifully platonic. They're perfect in theory, but they're just not connected to how the world actually works. And maybe the biggest flaw is that assumption of a normal, predictable market. It just completely fails to account for things like market crashes and sudden shocking events, which, happen a lot more than the theory would have you believe. Okay, so if the old map has some serious holes in it, what's a modern explorer supposed to do? Well, you get a better toolkit. It's time to talk about the practical, hands-on tools that actually help us figure out what a company is worth. So here are the essentials, the must-haves in your kit. First, you've got the PE ratio, which basically tells you how many dollars you're paying for $1 of profit. Then there's price to sales, which is awesome for young companies that aren't profitable yet. Price to book compares the stock price to a company's physical assets. And then the PEG ratio, which cleverly balances the price with how fast the company is expected to grow. One tool alone isn't enough, but together they give you a pretty clear picture. And this is so important. Context is everything. Look at this chart. A PE ratio of almost 8 sounds dirt cheap, right? Well, for the marine shipping industry, that's just average. Meanwhile, a PE of over 47 looks crazy expensive, but for health information services, that's pretty much the norm. You've always got to compare apples to apples. Yeah, just relying on one ratio is like trying to build a house with only a hammer. It's risky. You need a multi-tool. And that's where something more advanced, like the Petroski FCORE, comes into play. It's less of a single tool and more like a full diagnostic test for a company's financial health. It's actually pretty simple. It's a 9-point checklist. It asks basic questions like, is the company profitable? Is its cash flow good? Is its debt going down? For every yes, the company gets a point. If you find a company with a score of 8 or 9, that's a huge green flag that you might be looking at a really strong, possibly undervalued business. Okay, we've got our map, even if it's a little old. We've got our fancy new toolkit. We should be all set, right? Well, not quite.
There's one final obstacle in our treasure hunt, and it's probably the biggest one of all: our own brain.
You know, the crazy thing is, our own psychology is often our worst enemy. We make these huge investment decisions without even realizing what's influencing us. We get emotionally attached to a stock, we panic and sell at the worst possible time, we chase fads, and then we look back and think, what was I doing? And this quote from a financial forum just hits the nail on the head. It shows a really common problem, that emotional attachment. You've got someone who spent their whole life building a portfolio, and they want to pass on the actual stocks. But as this person points out, it's a total headache. It's hard to split up fairly, and most of the time, the kids just want the cash. Logic says sell, but our emotions tell us to hold on. And this really gets to the heart of it, knowing when to sell. We spend so much time and energy figuring out what to buy, but a lot of us just freeze when it's time to sell. Having a clear, disciplined strategy for selling is every bit as important as your buying strategy. In fact, failing to sell at the right time can absolutely crush your returns. So where does that leave us? Well, modern portfolio theory gave us a great starting point, a map, but it's not enough to navigate the real world on its own. We need modern tools like valuation ratios and the F-score to find real value. But at the end of the day, even the best tools are useless if we can't get a handle on our own psychology. Which leaves us with one final thought. Maybe the real hidden gem we're all looking for isn't a stock at all. Maybe it's a disciplined, unemotional strategy that guides every single move you make.